Welcome to this explainer. Okay, so if you're preparing for your ACCA Audit and Assurance exam, you already know the syllabus can feel, well, incredibly dense. But instead of just mindlessly memorizing isolated rules, we're going to do something way more effective today. We'll actually be walking chronologically through the real-world timeline of an auditor taking on a brand new client. By understanding the actual life cycle of an engagement, I promise you, these concepts are going to lock into your brain so much more logically.
Right, let's dive right in with a super fundamental question. What exactly is an audit anyway? It's really easy to get totally lost in the technical jargon, but at its heart, an audit exists to solve a massive real-world problem. Think about it. Investors and stakeholders are out there relying on financial statements to make huge economic decisions. But how do they actually know management hasn't made some massive errors? Or even worse, committed outright fraud? Well, through this explainer, we're going to look at the exact framework auditors use to solve that exact problem.
So here's our quick roadmap for today. Step 1, what is an audit? Step 2, rules of the game. Step 3, before you say yes. And finally, Step 4, the master blueprint. Let's get to it.
Section 1. What is an audit? The core mission.
Now, really pay attention to the specific language used here. An audit of financial statements is an independent examination to express an opinion on whether they give a true and fair view. Your absolute core mission as an auditor is to obtain what we call reasonable assurance that these financial statements are free from material misstatement. And that's whether that misstatement is caused by fraud or, just simple human error. You are literally the independent eyes verifying that the story management is telling the world actually matches reality.
Understanding the specific type of assurance you're providing is absolutely crucial. In fact, it is a massive exam trap, so watch out. Notice the contrast here. A statutory audit provides reasonable assurance. That is a high, but importantly not absolute level of assurance. And it results in a positive conclusion. Something like, in our opinion, the financial statements give a true and fair view. Now contrast that with limited assurance, which is what you'd see in, say, a review of interim statements. That results in a negative conclusion. Like, nothing has come to our attention that indicates they are not prepared properly. So lock in that visual difference right now. Positive means reasonable. Negative means limited.
To anchor this first section in your mind, here is a bite-sized, one-line summary to easily recall under exam conditions. Audit equals independent opinion on truth and fairness of financial statements. Say it, visualize it, and boom, you've got the core definition nailed down.
Moving right along to Section 2, rules of the game, regulatory and ethical framework.
So, in the UK, the profession is overseen by a few key players. First up, the Financial Reporting Council, or FRC. They're the ones actually setting the UK auditing standards, which we call ISAs. Then you have the professional bodies themselves, like the ICAEW and ACCA, who monitor their members to make sure everyone is staying compliant. And finally, if you're dealing with listed companies, the FCA, that's the Financial Conduct Authority, they step in as the regulator. Long story short, you absolutely must follow the rules set by these bodies, no exceptions.
But hey, it's not just about technical standards. There's also the ethical code to consider. The ACCA code demands integrity, objectivity, and professional competence. And this brings us to the 5 specific threats to an auditor's independence. First, you've got the self-interest threat, like holding shares in a client. Then there's self-review, where you're essentially auditing your own previous work. Yikes. Advocacy is next, where you find yourself promoting the client's position a little too much. Familiarity happens when you get just a bit too cozy with management. And finally, intimidation, where the client actually pressures you, maybe by threatening to replace your firm entirely.
If you want a really powerful visual imprint for exam day, just remember this punchy acronym, SSFI. SSFI. Self-interest, self-review, advocacy, familiarity, intimidation. If you ever spot any of these SSFI threats in an exam scenario, you immediately know you need to implement safeguards to reduce that threat to an acceptable level. Or, as an absolute last resort, you just have to resign from the engagement.
And here is your one-line summary anchoring the regulatory phase. Auditors must follow ethical code, auditing standards, and company law. Like we said, these rules, totally non-negotiable.
All right, on to Section 3, before you say yes, acceptance and appointment.
Let's actually walk through the exact chronological steps you must take before you even think about signing on the dotted line. Step 1, evaluate the integrity of management. Honestly, if they're fundamentally dishonest, just walk away. Step 2, assess your own team's competency and resources.
Do you actually have the time and the specific expertise to pull this audit off? Step 3, ensure your independence and check that there are no unmanageable SSAFI threats. Step 4, determine if the financial reporting framework they're using is actually acceptable. And finally, step 5, if all those boxes are checked, you obtain the engagement letter.
Okay, once all those boxes are checked, we move straight to ISA 210. The engagement letter basically documents the exact terms of the engagement. It lays out the objective, the scope of your work, the specific responsibilities of management versus you as the auditor, the fees, and the reporting structure. Crucially, though, this absolutely must be sent before the audit commences. Getting this contract sorted up front prevents severe misunderstandings, establishes really clear boundaries, and honestly, it can protect you from potential lawsuits down the line.
So your big takeaway for this phase is super simple. Engagement letter equals contract between auditor and client, sent before audit. Seriously, never start the real work without it.
And finally, Section 4, the Master Blueprint, Audit Planning.
Under ISA 300, audit planning is absolutely vital. You might be wondering, why do we spend so much time planning? Well, because skipping this phase literally leads to disaster. A proper plan ensures you're devoting appropriate attention to the most important areas of the financial statements. It helps you identify and address potential risks super early on. Plus, it allows you to efficiently assign work to the right team members based on their actual experience. And it facilitates proper review and direction of the whole audit. Bottom line, a good plan sets up the entire engagement for total success.
Now, building this strategy happens step by step. Let's put you right in the shoes of the lead auditor for a second. First, you understand the entity. You analyze their environment, their industry, and their internal controls. Next up, you assess risks to identify exactly where material misstatements are most likely to hide out. Then you determine materiality. That means setting the specific financial thresholds that would actually influence a user's economic decisions. Based on all of that info, you design procedures, deciding the nature, timing, and extent of the actual audit work. And finally, you pull the whole shebang together to prepare your strategy.
Let's lock in the core components of this final phase with our last anchor for the day. Planning equals understand entity, assess risk, set materiality, design procedures. Trust me, if you just followed that specific sequence, you will never get lost in an exam scenario.
So we've walked through the entire life cycle. You know the ultimate objective, you know the strict ethical rules, you've successfully evaluated and signed to the client, and you've built your master blueprint for the audit. But having a plan is really just the beginning, isn't it? The real challenge is executing it. You've planned the audit, sure, but are you ready to actually hunt for the risks? That provocative question is exactly where the real detective work begins, and it's what you'll absolutely need to master next. Thanks so much for joining me on this explainer, and definitely keep that structured life cycle in mind as you study. Okay, let's dive right into this explainer. Today, we're not just looking at the audit as some dry compliance exercise. No, we're treating it like an active investigation. We're handing you the ultimate detective's toolkit to master ACCA Audit and Assurance, specifically zeroing in on audit evidence and substantive procedures. Whether you're gearing up for your exam or you just really want to understand how auditors actually uncover the truth behind corporate financial statements, you are definitely in the right place.
So here's our roadmap for this investigation. We're going to cover decoding audit evidence, substantive procedures explained, action verbs that score, tackling inventory, and finally, testing receivables. Let's get to it.
Section 1. Decoding audit evidence. What exactly are our clues?
You know, every great investigator needs clues to solve a case. For us financial auditors, those clues are defined by ISA 500. But look, evidence isn't just about grabbing literally any document you can get your hands on. ISA 500 demands two very specific qualities. First up, sufficiency. That's your quantity. Like, do you have a big enough sample size to actually support your conclusion? Second, appropriateness. That's the quality. Is this info actually relevant to what we're testing, and is it reliable? I mean, you could have a literal mountain of irrelevant documents. Sure, you've got sufficient quantity, but your appropriateness is terrible. You absolutely need both to back up your final audit opinion.
Now look at this hierarchy of reliability, because let's face it, not all evidence is created equal. Up at the absolute highest level, we've got external sources sent directly to you, the auditor. Think of a confirmation letter straight from the client's bank. Management literally can't tamper with it. Then, sitting in the middle, internal documents. These are only reliable if the company's internal controls are actually strong. And right at the bottom, oral inquiry. Basically just asking management a question. That is the weakest form of evidence, hands down. You can never ever base your opinion solely on what someone just tells you.
Okay, I want you to lock this one-line summary firmly into your mind. Evidence equals sufficient plus appropriate, and external direct is the most reliable. That right there is the golden rule for gathering your audit clues. Always prioritize that external, direct evidence over anything generated internally.
Moving on to Section 2. Substantive Procedures Explained. These are our investigative techniques.
All right, so we know what our clues are, and we know which ones are the most valuable. Now we have to figure out how to actively hunt them down using ISA 330. You can think of substantive procedures as your direct, active investigative techniques. You're going to deploy these heavily whenever your assessment of the client's internal control risk is high, or when you're looking at really material, high-value balances. Remember, we aren't testing the company's systems here. We are testing the actual numbers on the page to see if they're materially misstated.
So you've got two main methods of attack here, and you'll want to use a combo of digging into the details and looking at the big picture. Test of detail literally means getting in the weeds, like pulling a specific 10,000-pound sales invoice and physically tracing it to a shipping document. Analytical procedures, on the other hand, mean stepping back. For example, if revenue shot up by 20% this year, but the cost of sales only crept up by 2%, well, that relationship looks pretty strange, right? Analytical procedures flag that anomaly for you so you know exactly where you need to point your tests of detail.
All right, Section 3. Action verbs that score. This is all about communicating like an expert.
Let's pause for a really critical exam strategy moment here. Knowing what to do in the field, that's great, but the examiner cannot read your mind. They can only read your verbs. You have to map the correct active verb to the exact action you are taking. If you're examining a document or an asset, the word is inspect. If you're watching someone else do their job, say warehouse staff counting boxes, you observe. Writing to a third party for a direct response, you confirm. And if you're checking the math on a schedule, you recalculate. These are the exact professional terms the examiner is hunting for.
And please, whatever you do, avoid the classic exam trap of being vague. An auditor doesn't just casually check things or verify a balance. Those words are completely meaningless on an audit paper because they just don't tell the examiner how you did it. Did you check it by looking at it? Did you recalculate it? Did you ask someone? Always use those specific active verbs we just talked about to absolutely guarantee you score your marks.
Section 4. Tackling Inventory. Welcome to the physical crime scene under ISA 501.
Let's take our toolkit out into the field, starting with a heavily tested area, the year-end inventory count. The real trick here is breaking down a massive, sometimes chaotic warehouse count into 3 manageable chronological phases. Before the count, you plan. You review management's instructions to make sure they're actually sound. During the count, and remember our verbs here, you observe the staff to ensure they're following those instructions, and you perform your own test counts on a sample. Then, after the count, you make sure the physical quantities you literally just witnessed are accurately transferred over to the final inventory valuation listing. Now, embedded right at the end of that inventory process is perhaps the absolute most heavily tested concept, cutoff. Cutoff testing is basically your primary defense to ensure management hasn't accidentally or maybe intentionally blurred the lines between this year's goods and next year's. To do this, you've got to note down the very last goods received note, or GRN, and the last dispatch note of the financial year. Then you trace those documents directly into the accounting system. You're making sure goods that arrived on December 31st are included in this year's inventory, and goods dispatched on January 1st are strictly excluded.
On to Section 5. Testing receivables. It's time to confirm the paper trail.
So, when a company claims its customers owe them millions of dollars, well, we can't just take their word for it, right? Sending letters to customers, which we call circularization, generates that highly reliable external evidence we talked about earlier. But you have to choose your strategy carefully here. A positive confirmation is aggressive. You use it for large balances where you strictly require a reply to prove the debt actually exists. A negative confirmation is much more passive. You use that for a high volume of small balances where you basically assume silence means they agree with the bill.
But wait, every good investigation hits a dead end at some point, and that requires a contingency plan. So what exactly do you do when a major customer just flat out ignores your positive confirmation letter? You demanded a reply and you got absolute silence. You obviously can't just shrug and assume the balance is correct. Well, when you're faced with a non-reply, you pivot immediately to these alternative substantive procedures. First, look into the future. Check the bank statements after the year end. Did the customer pay the bill in January? Because if they paid it, the debt obviously existed back in December.
If they still haven't paid, you have to dig backward into the internal paperwork. You inspect the original sales invoice and the dispatch note bearing the customer's signature. That proves the goods actually left the building and were accepted by the client.
Let's lock in this final summary to ensure you've got a complete mental checklist for handling any receivable scenario. First, you attempt to confirm the balances directly. If that fails, you execute your alternative procedures. And finally, always review the allowance for doubtful debts. Because hey, just because a customer owes the money doesn't actually mean they can afford to pay it.
So, if evidence is just a clue and substantive procedures are your toolkit, are you ready to uncover the truth behind the numbers? Armed with a solid grasp of ISA 500's evidence hierarchy, the active techniques of ISA 330, and the exact scoring verbs you need, you are totally equipped to handle complex areas like inventory cutoff and receivable circularization. I challenge you to view your next exam or your next financial review not just as a standard compliance test, but as your next big case to crack. Thanks for joining this explainer, and good luck out there in the field.
Welcome to this explainer, right? Let's jump straight in. We are setting the stage for the absolute endgame of an audit. If you really think about it, an auditor is kind of like a financial detective. You know, you spend weeks, maybe even months, gathering evidence, really understanding the business, and assessing all those risks. But eventually, all that investigative work, it has to come to an end. It's time to gather your evidence, survive the partner review, and finally, deliver the verdict. So that naturally leads us to a big question. How does an auditor actually finalize their investigation and deliver that ultimate verdict? This phase, which we call audit completion, well, it isn't just about packing up your working papers and going home. No, it is a highly structured, absolutely critical phase. It's where all those loose threads get pulled together to make sure the final opinion is, well, rock solid. Think of it as the final, thrilling chapters of a major financial investigation. Okay, let's dive into our roadmap for today. We'll be looking at the final audit checks, then fraud and subsequent events, assessing going concern, the auditor's opinion itself, and finally those extra paragraphs, KAM, EOM, and OM. Let's get to it. Section 1, the final audit checks. It's time to tie up those loose ends. Now, before any sign-off happens, an auditor has to run through a really rigorous chronological sequence. We need to ensure no stone is left unturned. First up, Step 1, reviewing uncorrected misstatements. We analyze these both quantitatively and qualitatively. Then, Step 2 is reviewing subsequent events. Step 3 is concluding ongoing concern. Step 4, obtaining written representations from management. And finally, Step 5, preparing the management letter. That's the letter that flags significant internal control deficiencies and gives recommendations to those charged with governance. This exact sequence, that forms your ultimate investigative roadmap for audit completion. Let's zoom in on Step 4 for a second, under ISA 580, written representations. This is a super common trap. Basically, management is confirming they've fulfilled their responsibilities, or maybe confirming their going concern assessments. But listen closely. This absolutely cannot replace actual hard audit evidence. It's a confirmation, not a substitute. If management outright refuses to provide them, wow, that's a massive red flag. It forces our detective to confront governance and could potentially modify the entire audit opinion. Moving on to Section 2, fraud and subsequent events. Here we need to understand intent versus the timeline. This is where our investigation gets incredibly nuanced. Under ISA 240, we have to draw a really hard line between fraud and error. Error, well, that's simply an unintentional mistake. It happens. But fraud, that is an intentional act. It usually falls into two distinct buckets: misappropriation of assets or fraudulent financial reporting. And because fraud is deliberately concealed, it reminds us of the absolutely crucial need for unwavering professional skepticism throughout the entire audit. We can never, ever just assume management is being completely honest. We have to question, corroborate, and verify every single alibi. Then we have subsequent events under ISA 560. Adjusting events kind of act like a time machine. Because there is evidence that the condition already existed at the year end, we are required to literally adjust the numbers in the financial statements. On the flip side, non-adjusting events arose strictly after the year end. So for those, we don't touch the numbers at all. We just disclose the event in the notes so the users are aware. See? No time travel required. All right, Section 3, assessing going concern. Essentially, we're checking the entity's survival. So under ISA 570, we are basically checking the pulse of the patient. We're on the lookout for financial indicators like loan defaults or operational ones like maybe losing a massive key customer. But this assessment isn't infinite. Management and the auditors reviewing their work must rigorously assess the entity's viability for the foreseeable future. And the standards strictly define that as at least 12 months from the reporting date. If the company looks like it might flatline in that 12-month window, well, we have a huge reporting implication on our hands. Think of this next part as a mental flowchart. If there is a material uncertainty about the company's survival, but management adequately discloses it, the auditor gives a clean, unmodified opinion. They just add an emphasis of matter to point it out. But if management tries to sweep it under the rug and the disclosure is inadequate, the auditor must issue a qualified or adverse opinion. And if there are just too many multiple uncertainties, making it literally impossible to form a conclusion, the auditor issues a disclaimer. So, the adequacy of management's disclosures entirely dictates your final verdict.
Section 4, the auditor's opinion. This is the ultimate verdict.
After all the planning, all the substantive procedures, and those final checks we just talked about, this is the document where the final judgment is delivered. The golden phrase of auditing is, in our opinion, the financial statements give a true and fair view. It's a positive conclusion, it offers reasonable assurance, it is an unmodified stance, and frankly, it is the exact sentence that every single company hopes to hear, and they breathe a massive sigh of relief when they do. But as you know, our investigations don't always end perfectly. There are actually 4 types of opinions. Unmodified is that clean bill of health, but if the auditor uncovers significant problems, they modify the report. A qualified opinion says everything is true and fair except for a specific issue. An adverse opinion? That's the absolute worst case scenario. The statements do not give a true and fair view. And a disclaimer means the auditor was completely unable to obtain enough evidence to even form an opinion. They basically just have to walk away from the crime scene. So the absolutely crucial point here is knowing exactly when to use which modified opinion. And it all comes down to understanding the difference between material and pervasive. Honestly, getting this judgment wrong is exactly how auditors end up in the news. A material issue influences user decisions, sure, but it's isolated. Maybe it's just a single inventory error. That gets a qualified opinion. But a pervasive issue? That affects the majority of items, or it's absolutely fundamental to understanding the statements, like misstating revenue, receivables, and cash all at the exact same time. Pervasive issues force an adverse or disclaimer of opinion. Moving to our last section, Section 5, KLM, EOM, and OM. These are the extra report paragraphs. Now, these extra paragraphs are special communication tools for the auditor to speak directly to the users, and they are incredibly common exam traps. First up is Key Audit Matters, or CAM, under ISA 701. These are the matters of most significance in the audit. Why was a certain area significant, and exactly how did the auditor address it? It gives stakeholders a really cool peek behind the detective's curtain. But remember, this is required exclusively for listed entities, public interest companies. And please note, a CAM is never, ever a substitute for modifying your opinion if the financials are actually wrong. Next, we have emphasis of matter versus other matter paragraphs. Let's clear up the confusion here. An EOM under ISA 706 draws attention to a matter that is already properly presented and disclosed in the financial statements. Think of a major subsequent event or a properly disclosed going concern issue. An other matter paragraph, however, is for something completely outside the financial statements that is still relevant to the user's understanding, like pointing out that the prior period was actually audited by a completely different firm. And just like that, we're at the end of our explainer. We've gone from the final checks all the way to the specific wording of the final audit report. So here is my final question for you. You know the rules now, but can you apply these standards and truly think like an audit partner? Can you look at a complex scenario, show real professional skepticism, and confidently issue the final conviction? Keep this investigative framework in your back pocket, and you'll be able to navigate any audit completion. Thanks for hanging out with me, and keep exploring. Hey everyone, welcome back. Today's explainer is going to be incredibly practical, especially if you're gearing up for the AAA ACCA exam. We're opening up the auditor's playbook to really track a company's financial life cycle. We're going to systematically break down how an auditor looks at exactly where a company's money comes from, where it goes, and where it just sits. If you've ever felt totally overwhelmed by the sheer volume of audit procedures out there, well, this is exactly what you need. We're going to take those massive textbooks and turn them into actionable, high-yield strategies. Okay, let's dive right in. Here's our roadmap for today.
We're going to conquer 5 specific high-yield syllabus areas: revenue, payables and purchases, payroll, non-current assets, and finally, bank and cash.
Before we hit that first area, we really need to anchor this whole explainer with one core definition, because everything we discussed today revolves around this: substantive procedures. These are the direct evidence-gathering tools we use to detect material misstatements at the assertion level. We aren't just talking about the theory of internal controls here, right? We're rolling up our sleeves. We're doing tests of detail, using analytical procedures, and verifying actual real-world transactions and account balances. Listen, pay close attention to this next part because it is literally the secret to scoring high marks in your exams. Generic words like check or verify, they score an absolute 0. No marks. You have to use active, specific verbs. You inspect a document or a title deed, you observe an inventory count, you confirm a balance directly with a bank, you recalculate the math on depreciation, and you reperform a bank reconciliation. Seriously, memorize these verbs. They're the absolute foundation of every single good audit procedure we're about to cover.
All right, Section 1, Revenue, tracking the top line.
So, this is stage 1 of our playbook, seeing how the company actually makes its money. And what I love about this is how beautifully it links a specific risk, the relevant assertion, and the active audit procedure used to test it. Take overstatement, for example. Companies absolutely love to look profitable, so the risk of overstating revenue is super high. To test the occurrence assertion, you don't just stare at the sales ledger. No, you select a sample of sales invoices and actively trace them back to the dispatch note and the customer order. To catch cutoff errors, you test sales immediately before and after the year-end against their actual dispatch dates. And to find those sneaky side agreements, you review credit notes issued after the year-end to see if they were actually returns of pre-year-end sales. I want you to lock this crucial, bite-sized takeaway into your mental playbook right now. When you see revenue in a scenario, think occurrence by tracing invoices to dispatch, cutoff testing, margin analysis, and checking returns after year-end. Keep that in your back pocket. Moving on to Section 2, Payables and Purchases, tracking outflows. Now we're shifting the narrative to the money going out, where the primary risk completely flips to understated liabilities. Now, what's really interesting here is the contrast between verifying what the client tells you they owe versus hunting for what they're hiding. On one hand, testing standard payables is fairly straightforward, right? You just reconcile supplier statements to the payables ledger. That tests the completeness and valuation of known accounts. But on the other hand, you have the search for unrecorded liabilities. This is where you, the auditor, have to actively hunt for missing obligations that management might have, conveniently forgotten to record to make their balance sheet look a little nicer. So how exactly do we conduct that active hunt? Well, it's a step-by-step process. First up, you grab the sequence of goods received notes, the GRNs, from right before the year-end. Second, you trace those specific notes directly into the purchase ledger to make sure the liability was actually recorded. Finally, you look at invoices that arrived after the year-end and you check the service dates to see if the work was actually done before the year-end. If it was, but it's nowhere in the ledger, boom! You've just found an unrecorded liability. So here is your crucial punchline for testing those outflows. Payables equals supplier statement reconciliation, the cutoff test, and that active search for unrecorded liabilities. Say it, write it down, remember it.
Okay, Section 3, Payroll, testing employee costs.
Payroll is usually the largest expense for a business, which carries a massive risk of paying fake or ghost employees. The logic of testing this is actually really structured. First, does the human actually exist? Well, you prove that by selecting a sample of employees and agreeing them to independent HR records, like their original contract and start date. Second, are the amounts correct? You literally grab your calculator and physically recalculate the gross pay, rate times hours, plus the tax deductions. Finally, did the money actually go to the right place? You agree the net pay from the payroll records directly to the bank transfer listing. It's a completely closed loop of evidence.
Just to absolutely cement this in your mind, payroll equals agreeing employees to HR records, recalculating the gross and net pay, and checking the authorization of any master file changes.
All right, Section 4, Non-Current Assets, verifying PPE.
So, this is all about verifying what the company buys and holds onto over the long haul. The crucial point here is that auditing PPE isn't just about staring at a big piece of machinery. Look at the breadth of procedures you have to do. You start by agreeing opening balances to prior year working papers. For additions, you inspect the invoice and physically verify the asset actually exists. For disposals, you agree the proceeds to the bank and check the gain or loss calculation. You absolutely must recalculate depreciation rates based on useful life. And finally, you perform a review for any indicators of impairment. It's a really multifaceted testing approach. Wrapping up non-current assets, just remember this motif. PPE equals testing additions via invoices and physical checks, testing disposals via proceeds, recalculating depreciation, and reviewing for impairment. And that brings us to Section 5, Bank and Cash, confirming balances. This is where we look at where the company stashes its highly liquid funds. Now, remember our audit evidence hierarchy? External evidence obtained directly by you, the auditor, is the absolute gold standard. That's exactly why the bank confirmation under ISA 505 is so vital. It's a direct request to the bank, sent right on the auditor's letterhead, which brilliantly tests the existence and rights assertions of those bank balances, while also catching any hidden loans or guarantees. But here's the catch. A confirmation letter just isn't enough on its own, mainly because of timing differences. You have got to test the bank reconciliation. To do this, you agree the bank statement balance to the cash book. Then you trace outstanding lodgements to the subsequent bank statement to make sure they cleared. You do the exact same thing for unpresented checks. And crucially, you must investigate any old, stale, unpresented checks that might be hiding a cash overstatement. Doing all this builds a complete, accurate picture of the true cash position. All right, here's your final summary for these specific audit areas. Bank equals direct confirmation from the institution, plus testing the reconciliation, verifying existence, and rights. Let's pivot slightly. The exam trap, avoiding generic answers. So now that we've got the playbook down, we really need to talk exam strategy, because honestly, all this technical knowledge is completely useless if you fall into this trap. This is arguably the most important role in this entire explainer. Memorizing procedures is not enough. If you just write down a generic textbook procedure, you will score 0 marks. 0. You must combine the active verb, like inspect or recalculate, with the specific assertion and then directly link it to the specific details of the client scenario they gave you. You have to tell the examiner exactly which document you are inspecting for this specific client. So, I'm going to leave you with this provocative thought. In your very next practice session, how are you going to consciously link those active verbs and assertions to the specific facts of your scenario? Think like a real auditor, apply the playbook we just built today, and avoid those generic answers like the plague. Keep learning, stay focused, and we'll see you in the next explainer.
Welcome to This Explainer. Okay, let's dive right in and build your ultimate auditor's toolkit. If you're tackling the ACCA Audit and Assurance exam, or, if you just want to understand the true bedrock mechanics of a financial audit, you are in exactly the right place. Today, we're going to systematically break down how an auditor confidently identifies and tackles material misstatements. We're turning all that complex theory into a highly practical, structured toolkit so you can navigate those tricky exam traps and real-world scenarios alike. Let's get to it.
Here is our roadmap for today. We'll start by setting the materiality threshold, then we'll calculate audit risk, test assertions, evaluate internal controls, and finally, test those controls in practice.
All right, let's kick things off with part 1, setting the threshold, also known as materiality. So before an auditor does anything, we have to establish exactly what size of an error actually matters. Materiality sets the stakes for the entire audit process. I mean, it's not just about hunting down every single missing penny, right? It's about identifying the misstatements, whether that's one giant error or a cluster of tiny ones, that would reasonably change the economic decisions of the users. Basically, if an error wouldn't change an investor's mind, it's just not material. This concept literally defines our baseline for the entire audit.
But how do we translate that somewhat abstract concept into a hard numerical threshold? Well, we use standard mathematical benchmarks. We can't just guess what might sway a user's decision. Typically, auditors look at about 5% of profit before tax. Now, for nonprofits or maybe companies operating at a loss, we might pivot and look at 1% of revenue or total assets, or roughly half to 1% of equity. This gives the audit team a highly concrete dollar amount to work with when they're out there deciding what to actually investigate.
Now you might be wondering, what happens if a bunch of little errors sneak by? This is where a vital safety measure comes in, performance materiality. Your overall materiality is that big, overarching number we just talked about. But if we only look for errors of that exact size, a bunch of smaller, hidden errors could easily slip through, add up together, and break that threshold. We call that danger aggregation risk.
To fight this, auditors use performance materiality. It's essentially a safety buffer, usually set between 50 and 75% of the overall materiality, and we use it during our day-to-day testing. It just makes sure the little things don't sneak up and become a massive problem.
Moving right along to part 2, calculating the threat, which brings us to audit risk.
To map out the threat landscape of any engagement, we rely on one absolutely foundational formula. Audit risk equals inherent risk times control risk times detection risk. If you're prepping for the ACCA AA exam, this right here is non-negotiable. You absolutely must understand how these 3 specific puzzle pieces fit together to create the total risk profile of your audit.
Let's break those down. Inherent risk is the raw, natural susceptibility of an account to be wrong, completely ignoring any safety nets. Like highly complex foreign currency transactions, huge inherent risk. Then we have control risk, which is the danger that the client's own internal safety nets fail to catch an error. Now, as an auditor, you can assess these two, but you can't change them. They are what they are. However, detection risk, the risk that your own audit procedures completely miss the error, is the only dial you can actually turn. If inherent and control risks are dangerously high, you've got to actively lower your detection risk by doing more work. Think larger sample sizes or bringing in more experienced staff.
Okay, part 3, testing the truth with assertions. When management hands over their financial statements, they aren't just giving you numbers. Actually, scratch that. It's more like they're making implicit promises or assertions about those numbers. We split these into 2 main buckets. First, classes of transactions. These cover events that happened over the year, like your sales or purchases. Second, account balances. These are the static, year-end numbers, like inventory or receivables. And to remember how to test these, we use some incredibly effective memory hooks, the mnemonic PI for transactions and CAR for balances.
Let's zoom in on transactions for a second and unpack that PIE acronym. It's a high-yield memory hook that links every single audit procedure you design back to a concrete goal. Occurrence proves a recorded sale actually happened, meaning it's not some ghost transaction. Completeness is the exact reverse. It makes sure every real sale actually made it onto the books. Accuracy ensures the math is spot on. And cutoff, which, by the way, is a massive topic for exams, proves the transaction was recorded in the correct financial year. Just remember, every procedure you write must target one of these specific assertions.
Which brings us to part 4, the client's first defense, internal controls. So, think of the 5 COSO components as the fundamental layers of armor designed by management to ensure reliable reporting and to stop those material errors dead in their tracks. It all starts with the control environment, often called the tone at the top, because let's face it, if management doesn't care about the rules, no one else is going to care either. From there, they have to assess their own risks, maintain a solid information system, implement specific control activities to catch or prevent errors, and lastly, monitor the whole shebang to make sure it's actually working week after week.
But how do these abstract ideas look in the real world? Well, authorization means someone in charge actually has to say yes before spending money. Segregation of duties is a huge one. You never ever let the person who orders the goods also pay for them. That is literally just asking to be defrauded. Physical controls are exactly what they sound like, putting a padlock on the warehouse door or having strong IT passwords. And reconciliations are simply making sure 2 independent sets of records actually match up at the end of the day.
And finally, part 5, testing those controls in practice. Now, if you want to absolutely crush the ACCA AA exam and, frankly, survive real-world audits, you need to use the DIRT methodology. It's your blueprint to flawlessly handle any control deficiency scenario. When you spot a weakness, first state the deficiency, what exactly is missing. Next, the implication, what's the real-world risk of fraud or error here. Third, offer a recommendation, a realistic way to fix it. And finally, design a test of control to prove your recommendation is actually operating effectively. DIRT is the ultimate cheat code for structuring high-scoring answers.
For that final test of control step, you've got to use strong, direct, active verbs. Never just say you're going to check something. That is way too vague for an auditor. Instead, you inspect a document for a signature. You observe the warehouse staff physically separating duties. You reperform the bank reconciliation yourself to see if their math holds up. And you inquire by asking management questions. Just keep in mind, inquiry on its own is the absolute weakest form of evidence. You always have to back it up by inspecting, observing, or reperforming.
So, we've defined our threshold, mapped the risk equation, targeted assertions, evaluated controls, and applied the DIRT method. You now have the ultimate blueprint. But I want to leave you with a final thought to take into your next exam or client engagement. No matter how incredibly well-designed a company's armor looks on paper, where is the human element going to step in and cause that exact system to fail? Stay skeptical out there, and happy auditing.
Listen to me closely. If your ACCA exam is literally days away and you're feeling totally overwhelmed, just stop right now. Take a deep breath. You are in exactly the right place. Welcome to this Masterclass Explainer. I'm here to execute a rapid-fire, completely no-fluff rescue mission to get your brain locked in and exam ready. We're cutting out all the noise, dropping the textbook filler, and focusing exclusively on the high-yield, pure signal concepts that are going to drag you across that pass mark. So I need your absolute, undivided focus for the next few minutes. Let's get into it.
I want this to burn into your memory right now. You will learn more from your mistakes than from any notes. Listen, this isn't just some cheesy motivational poster. This is your absolute battle cry for these final hours. Stop passively reading endless pages of text. The ACCA examiner is not going to test your ability to highlight a textbook. No way. They are testing your ability to navigate their traps. And honestly, the absolute fastest way to learn how to dodge those traps? Fall into them right now, figure out exactly why you fell, and make sure you never, ever do it again.
So here is our 3-step game plan to get you exam ready. Number 1, ultra-fast revision. Number 2, common exam mistakes and fixes. And number 3, practice strategy. Let's kick things off with Section 1, ultra-fast revision.
All right, shift your brain into top gear right now. No more long paragraphs. We are hardwiring one-line triggers into your mind so they fire off automatically. Boom. Adjusted present value. If you're sitting advanced financial management, this is an absolute must-know. APV literally separates the operating NPV from the financing side effects. You need to instantly generate this formula in your head. Base case NPV plus the present value of the tax shield on debt minus your issue costs plus the present value of any subsidized loan benefits. Drill that exact sequence. Base plus tax shield minus issue plus subsidy. Lock it in.
Okay, let's see how fast we can trigger your recall across different papers. Ungearing beta, you're removing financial risk using 1 minus the tax rate. Target costing, it is always the target selling price minus your desired profit, and you absolutely must close that gap with value engineering. Throughput, it's simply your sales revenue minus direct material cost only, and your entire goal is to maximize it per bottleneck hour. Lock these associations into your brain immediately. Now let's talk relevant costs. These are strictly future incremental cash flows. I honestly cannot emphasize those two words enough. Future, incremental. You know, the examiner absolutely loves to bury sunk costs, like market research you've already done or machinery you've already bought, deep into the scenarios just to waste your time and destroy your calculations. Listen to me. If it's already spent, it is sunk. Ignore it completely and move on. Let's keep this intense pace going. Notice how quickly we can switch contexts here, just to prove your memory works. In advanced performance management, dysfunctional behavior means gaming the system, short-termism, or budgetary slack. Now, switching to tax, BARDR, that's business asset disposal relief, means a 10% rate up to a $1 million lifetime limit. Back to PM, shutdown decisions. We only shut down if the avoidable fixed cost savings are strictly greater than the lost contribution. Snap, snap, snap. That is exactly how fast your recall needs to be. So, why do good students fail ACCA exams? Think about that for a second. I mean, they know the formulas, they've read the books, so why do they get 48 or 49% and fail? Well, it's because they walk blindfolded right into the examiner's favorite traps. Let's fix that right now.
Which brings us to Section 2, Common Exam Mistakes and Fixes.
This is your ultimate shield. We're bringing the energy right back up to maximum, because here is where you secure those extra 5 to 10 passing marks that will literally flip a fail into a solid pass. A classic, heartbreaking rookie error in APV calculations is using the WACC to discount the base case NPV. Doing that drops easy marks instantly. The brilliant fix? Base NPV must always be discounted using the ungeared cost of equity, or KE. Do not let financial leverage contaminate your base case. Separate it out. Now here is a massive trap in performance management. The mistake is spotting a target costing gap, doing the calculation, and just stopping. You calculate the gap is $10 and you move on. No!
The fix here is you must always recommend value engineering actions to close it. Standardize components, substitute cheaper materials, simplify the design. If you stop at the math, you're literally leaving half the marks sitting right there on the table.
So the crucial point here regarding divisional performance is this absolute examiner favorite. The mistake is blindly trusting return on investment, or ROI. You see, ROI tricks managers into sub-optimization. They'll reject a great project just because its return is slightly lower than their current division average, even if it completely beats the corporate cost of capital. It's crazy. The fix? Use residual income, or RI. RI gives you an absolute monetary amount and is the ultimate savior for making decisions that actually align with shareholder value. Okay, if you're taking the UK tax paper, do not ever mix these two up. The mistake is treating exempt VAT supplies as if they're zero-rated. They are totally different beasts. The fix is knowing that zero-rated means the tax rate is 0%, but you can still recover your input VAT on purchases. Exempt, on the other hand, means there is absolutely no input VAT recovery allowed. Hit that distinction like a hammer in your mind so you never, ever mix up input recovery rules again.
Moving on to our final phase, Section 3, Practice Strategy.
We're shifting from defense straight to offense. You have the rapid-fire triggers, you know the traps, but how are you actually going to spend your final 48 or 72 hours? I need you to follow these 3 exact steps. Step 1. Attempt the objective test questions and mocks in the ACCA free practice platform. Step 2. The timer is on. No pausing to check a textbook, no pausing to grab a coffee. You absolutely must simulate the brutal reality of the exam hall to build your stamina. And step 3, review your mistakes deeply, because honestly, that is where the actual learning happens.
I want you to screenshot this golden review template right now. Seriously, do it. For every single question you get wrong from here on out, you're going to do a forensic breakdown. What was the question? What was your answer? What was the correct answer? Why were you wrong? Was it a math error or a concept gap? And finally, what is the fix? If you use this framework for everything, your scores will absolutely skyrocket.
Now, let's look at this incredible rule and really build your confidence. Show all workings. Even if the final number is completely wrong, method marks count. Listen, the examiner is not your enemy. They actually want to pass you. If you multiply by the wrong tax rate in step 1, but your logic for steps 2, 3, and 4 is perfect, you are getting those marks. You just have to show your logical steps. Do not just write down a naked final number.
Here is an exclusive insider tip just for you in these final, high-pressure days. Take screenshots of the MCQs you get wrong. Create a dedicated album on your phone. Then revise them every single morning the minute you wake up and every single night right before you go to sleep. What you're doing is training your brain's pattern recognition. When you finally sit in that exam hall, your brain will instantly recognize the shape of the questions that used to trick you. It's a real game changer.
0. There is absolutely zero negative marking in ACCA. You must never, ever, under any circumstances, leave a question blank on the practice platform or in the real exam. If you're down to the last 10 seconds, just guess. A blank answer is a guaranteed 0. A guessed answer? That's a 25% chance of a mark. Leave nothing blank. Okay, take a deep breath. You have the tools, you understand the triggers, you know the traps, and you have the practice strategy. Now, you just need to apply them with absolute confidence. The hard work is already done. Now, you just need to execute. Go in there and pass this exam.
So I leave you with this final provocative challenge. Will you let the examiner's traps beat you, or will you use your mistakes right now to guarantee a pass? Get off this explainer, log right into the practice platform, start that timer, and go attack your mock exams. You've totally got this.